Hello, people on Facebook Live. This is John Dobis from Forbes at the Money Show in San Francisco. Joined with an old buddy, great stock picker, fine man by all accounts, John Buckingham from the Prudent Speculator newsletter. And John's been doing that for a couple of years now, right? Since 87. So you are a dyed-in-the-wool, I think I've written that about you, a dyed-in-the-wool value man. But, growth has been the way to go this year. You look at all the, Russell growth versus Russell value, and value's not way down, but down or flat, and growth seems stratospheric. What do you make of that? Is that a stupid designation to make in the first place because you can find reasonably priced stocks anywhere, or what? This is being a value guy. Defend yourself, will you?
Well, all of the above. I mean, it's true that value stocks this year have underperformed growth by a wide margin. Of course, the growth stocks are dominated by the Amazons, the Teslas, the Netflixes, the Facebooks of the world, and those stocks are generally expensive. Doesn't mean they can't keep becoming more expensive.
They've been doing that,
as that has been the case. But historically speaking, anyways, value stocks have outperformed growth by a wide margin, 13% to 9% over the long term. In our newsletter, The Prudent Speculator, we've had an excellent long-term return, focusing on value-paying stocks. So we accept that we're going to go through periods where, gee, I wish I would have had something else. But it's very important when it comes to investing, in my opinion, to be disciplined and be consistent in your strategy. Too many people end up switching from value to growth
at the wrong time.
Returns. Because if you remember last year, we outperformed value. Right. We were up 18%. S&P was up 12%.
Right.
And we did it with the same kinds of stocks that are underperforming this year.
When you say value, what do you mean in particular?
Well, we're focusing on companies that trade for low price earnings ratios, low price to book value, low price to sales, to traditional valuation metrics.
Compared to their own history, or compared to the market at large, or what? You say low. I'm just wondering.
Right. And that's a very good question, because if you only focused on a stock relative to all of the peers in the entire investment universe, you're going to be buying insurance companies because they trade for low price to book value ratios. So everything is relative. So we do like to look at where companies have traded historically. We also do consider where they trade relative to peers and so forth. So it's a complicated answer to the question. So for example, Apple or Microsoft can still be value stocks in our view because they have excellent balance sheets and reasonable valuations.
And things like a low PEG ratio or things like that.
Yeah, you can again, when you focus on fundamentals, there's ways to skew the data, no matter how to make it say what you want it to say. But in my opinion, we tried to be disciplined and consistent, and valuations matter. At the end of the day, we think that companies trading for reasonable prices are going to outperform those that are trading for expensive numbers.
Let's talk about a sector that you really have had to have an iron gut to go into and emerge alive. Retail. Sure. Amazon is taking market away from everyone, so goes the group think that even groceries now with the Whole Foods purchase. So you got companies out there like Kohl's, American Eagle, Abercrombie and Fitch, you name it. Nordstrom may be a little bit better off than some of the others because they might get taken private, but in a lot of those cases, you'll have price to book, price to sales, price to earnings, price to cash flow, less than their 5-year average, less than the market, and all this stuff. But sales are not growing. Is that a problem for you when you see something like that?
Well, certainly growth is part of the equation, even though we're value investors. So some of the names you mentioned we do own, Kohl's, American Eagle, but these are still companies where the earnings are at least staying relatively flat, and they're managing to navigate through the difficult environment. And we think they're ultimately going to be survivors on the other side. But more importantly, perhaps, the balance sheets are in excellent shape. So I think that's what you have to focus on when it comes to retail. You have many companies that are struggling to pay the bills, so to speak. And so I'd rather have something that's debt-free. You mentioned American Eagle Outfitters. They had very good earnings out. The stock has done extremely well, in the last few days. A company called DSW.
The shoe people, I noticed that. They were up 17% the other day.
And they're up another, yesterday and again today. So I mean, they've had significant appreciation. So there are opportunities, but you need to be selective.
I got you.
And of course, we obviously believe in broad diversification as well. So we're not putting significant portions of our portfolio into retail, but I do think there's still opportunity within retail. But you're right, you have to have a strong stomach, and you have to be willing to accept that there's media will accentuate the Amazon
It's easy to fall into the trap of believing,
Well,
oh my gosh, Amazon will take everyone's lunch away.
And the irony is that Amazon announced obviously the Whole Foods acquisition, and oh my goodness, they announced they're going to lower prices at Whole Foods, and I didn't know that could happen. How could they do that? So the price of Kroger goes down 8% in a day. Now, of course, saner heads kind of thought about this and said, I think Kroger's understands that there's a competitive threat coming from Whole Foods and Amazon, and they're already prepared for it. Now, it doesn't mean that they're going to navigate smoothly and everything, but Kroger has already been discounted significantly. So happily, in a day like today, Kroger stock bounced back significantly, as did many of the retailers. So we'll see if it's a dead cat bounce and if these stocks are just going to kind of tread water for a while. But boy, there's excellent values with high dividend yields, inexpensive multiples, and just as Amazon showed by buying Whole Foods, brick and mortar isn't dead.
Right. It's an attractive acquisition candidate sometimes. Thanks, John.
Thank you.